Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, an equity strategist for ADCB. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. In this series of podcasts, we've been discussing the Q3 2022 outlook for various asset classes. So far, we've covered the macro outlook and the equity market outlooks. Today, we would like to cover the outlook for rates. For that, we're joined by our in-house fixed income expert, Prerana Seth, who, by the way, is not new to this program. Prerana, good to have you back with us.
It's great to be back.
Prerana, multi-asset investors have had to experience a very tough first half of this year with equities entering a bear market. But more painful was the performance of fixed income assets, which in many cases were the worst on record. Fixed income assets contributed significantly not only to the drawdowns but also to the volatility of the portfolios. Why don't you start by giving us some context of how the fixed income asset class performance has been during the first half of this year?
Fixed income assets had a challenging first half of the year on the back of aggressive central bank policy response to the persistent inflation pressures. Global aggregate bond index declined by 14% in the first half of 2022, making its worst performance to date. Global inflation-linked bonds, in fact, were the worst performers in the first half of 2022. On the corporate side, global high-yield bonds came under pressure, recording 17% of losses, thus underperforming global investment-grade bonds, which posted negative return of 15%. Global treasuries accumulated losses of 15% as central banks further intensified their response to stem 40-year record high inflation pressures in the second quarter of this year. Within global treasuries, US treasuries accumulated losses of around 9% in the first half, and this was mainly led by the underperformance of long-dated bonds.
At the asset allocation level, we've been underweight fixed income assets but have added to our overweight position in US treasuries a couple of months ago. Against this backdrop, do you expect the first half of fixed income asset class performance trends to repeat themselves in the second half of this year too?
So the first half of the year for fixed income assets pretty much played out as we had expected. Inflation uncertainty and central bank policy path were the dominant drivers for the fixed income assets, with yields rising across the curve and bond market volatility reaching new highs. A short duration stance versus the benchmark worked in favor. However, we believe that the second half could in fact look relatively better for fixed income assets. Volatility is still likely to remain, but focus has now moved towards Fed's possible policy path and whether the central bank's aggressive stance could hurt the growth outlook. We believe that the rising recession risk could favor US treasuries given their safe haven characteristics. This also underscores our recent increase in allocation to US treasuries. At the same time, we believe now is the time to add duration exposure.
Thanks for bringing up the point with duration. Could you elaborate on what is our rationale for adding to duration now?
So our case for adding duration is backed firstly by the disconnect seen in between the rising recession probabilities and the upward trend in long-term US Treasury yields. The recent correlation which has turned positive between the movement in US Treasury yields and recession probabilities is something that is rare and has been rare in the past. Economic data has also started to point to increased slowdown risk. Secondly, market-based inflation expectations, the key driver for long-term bond yields, have also softened and may have already peaked. We believe these expectations could eventually start feeding into easing of consumer survey-based inflation expectations, which the Fed and hence markets and us are closely tracking. And finally, the long-term rates have now declined after touching the market-implied peak policy rate of around 3.5% and also fully pricing in a restrictive Fed policy, since the long-term rates are already trading well above the Fed indicated long-term neutral rate of 2.5%. Overall, rising rate cut expectations should eventually lead to a decline in bond yields, benefiting the long-dated bonds the most due to their interest rate sensitivity.
Prerana, as always, thank you for joining this program. Come back soon to share your perspectives on credit and currencies.
Thank you, Kishore.
Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information on what was discussed on this podcast or to access our latest quarterly investment view report, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. Stay tuned for more episodes where we discuss Q3 and H2 outlook for various other asset classes. You're listening to the Global Investment Insights podcast from ADCB Asset Management, and my name is Kishore Muktinutalapati.